Okay, this is your breaking news here. Well, it's not really that breaking, but I figured I'd report on it since I reported on it earlier this morning. We have the consumer confidence here coming in lower than expected. There's a couple reports here. Let me just walk you through the main overall confidence. So the previous confidence was at 130, and expected we were supposed to get one higher, but instead we got 3.3% lower, or 3.3 lower than expected. Actually, 4.3% lower. Excuse me. Um, and let me read you some more about that because there's a couple things to mention. Okay, so consumers' assessment of market conditions declined slightly, with business conditions the primary reason for the moderation. Despite the modest retreat in confidence, index levels remain historically high, and suggest further growth in the months ahead. Okay, the proportion of consumers expecting more jobs in the months ahead dipped from 19.1 from 22.4%, while those anticipating an improvement in business conditions decreased to 23% from 25%. So people expecting more jobs, uh, people who were expecting more jobs, um, it dropped. We got like over 3%, and people who were expecting an improvement in business conditions, that decreased by 2%. Um, an assessment of current conditions eased back this month, with the percentage saying conditions are good rising to 37.9 from 36.5. So a lot of people are saying conditions are good, um, and that percentage rose by 1%, while those saying conditions were bad um, jumped to 13.4 from 11.3%. So we had a bigger increase in people who thought the market was going down and conditions were bad. Um, so that's pretty much it for your consumer sentiment. But we're gonna also talk about um, let's see. The Richmond Fed Manufacturing Index fell 13 points. It's pretty much got a big range between 12 and 30 over the past 12 months, but a decrease is bad. So we got new orders declined to 17 from 27. That's really bad. Capital expenditures were eroded to 16 from 28. The prices paid index jumped to 2.39% versus 1.89% previously. So people are paying more prices, higher prices, um, with prices received at 1.54% from 1.7. Um, 6-month views improved. Shipments rose from 55 to 45. Well, I think because we have such a big inventory that we're shipping it out now. So I think that's nothing to really note. Future employment index increased from 31 from 22. Wages at 42 from 38, while new orders edged up to 45 from 40. So, I mean, I don't think this future shit. I don't agree with, and I doubt we'll see a big increase. Consumer sentiment's going down. You know, prices are going up. Uh, we're seeing a lot of bad effects going on, and we're starting to enter the excuse me, the not deflationary. This is in a sense, some items are being deflationary, like gold. Um, but there's a word. Deleveraging. That's what it is. That's what's going to happen. That's what's going to have to happen is the deleveraging of the markets, deleveraging of banks. It's kind of we have to go back to ground zero and start all over again. Okay, so the here we go. Now the home prices. Um, okay, the report. So we increased in the home price index, 0.1%. Um, the report rose 0.3% to 219.05 in January for the 20 city non-seasonally adjusted index, after edging up 0.18% to 204.48 in December. So we edged up quite a bit from December, from 204 to 219. The annual price accelerated slightly. The ten city index went from 219 from 218. All 20 cities posted annual gains, led by Seattle, Las Vegas, San Fran coming in third, and Chicago pulling up in the rear. Well, I guess that's not too hard to imagine. If supply is that low and no one's producing, um, you know, it's also the amount of people getting loans at this point are going to go down because overall the pressure for the bond market is going to go up, and uh, that's going to push mortgages higher and other borrowing capabilities, as well as the Fed tightening their policies, which is going to increase rates, the Fed funds rate, and basically make it more difficult and challenging for the markets to, or people to and go ahead and borrow. So let's get me lowered up here. Um, we're just gonna look at the market, see what's going on really quickly. Um, right now, the markets are doing very good for the bulls. Right now we aren't seeing too much selling happening. If the selling is gonna happen, it has to happen right now. Um, if you look here, we're up high, we're flagging. We barely had anything down here. So there's obviously extreme bullish pressure keeping this market up. I mean, we hit lower lows with the comp. That's not good. But S&P and Dow are up. The reason why they have more gains is because the Nasdaq really, really gained um, so much yesterday that it's the pressure. It can't go up. It has to go down. Whereas those stocks in the past, or not in the past, those stocks yesterday, Dow Jones and S&P, didn't go up as much, so they had a little more room to go up. And that's exactly what I thought was going to happen. I thought all the markets were just going to go up a little bit and then test down. But right now the comp is just failing the support yet again. We're almost underbought on a 3-minute chart. Let's pull it up on a 10-minute. See what the deal is. So yeah, it looks like we're failing. We had a big, big, big bear market on a 10-minute. And it looks like we're going for its second round. It looks like the S&P and Dow are both going in the same direction. On a 30-minute, it's a goodbye to the comp here. And what we could do is actually go on FinViz Yeah, look, actually the Dow had a little spurt of little orgasm here, and it couldn't get overbought, but it tipped off. So um, and same thing with the S&P. So we're pretty much at the top of the range here. So I don't know how much longer it can go, but it's pretty much overbought and it needs to come back down. Whereas the comp is starting to fail and starting to come back down already. Now let's just pull up uh, the FinViz real quick, and this is a great website. I'll link it. We got news, economic data, insider trading, earnings, uh, some trend, some technical support, head and shoulders, multiple top, channel down, etc. Forex bonds, crude oil. So what are we looking at across the board here? Well, gold is kind of neutral here. It's kind of weaseling its way back up. Um, you know, that's a good sign. It couldn't break that resistance, so it's going to revamp and try again. It's got support here at 1350. Um, so now we got nat gas is going up, crude oil's going up. Actually, nat gas is looks like it's going down a little bit. Um, but we're up on the day, I guess, even though the chart is oh, you know why it says it's green? It's I hate when they do that. It should be red because based on the yesterday's close and today's open were both negative, so I don't know why that's up. Um, Nasdaq 100, S&P 500, they're both kind of up a little bit on the day, but that can't last here. Bonds 30-year, we're at 3.05%, whereas the 10 years 2.8. So we're extremely close to that level where when when the yield goes up, when the yield goes up on the 10-year over the 30-year, that indicates we are going to have a recession or that we're in a recession. So I went over that with a previous video. Maybe I'll go over it again and look into the science and the formulas and why they think that that's not the case this time. We got some gainers here and some losers. We got Facebook down. People saying it's a hammer and it's ready, but it's going to come down a little bit more. Retest the 150 handle, and we'll call it that. Apple, we got a doji. Could go either way, but actually, no, it's going to go down, mate. It's going to go down. We're hitting support, resistance here. See, that's why you can't just look at this. If you just look at this, you wouldn't really see it. But if you pull up the Apple chart, you can clearly see it. So I'm not even going to comment. We got some news, not news, but, just so many gappers. Um, you know, let's see. Across the board, we're looking green. In FinViz, we got, let's click a bear. Now 50-50. Well, how about that? I'm the 50-50 maker. Great, that's really funny. So we're pretty much right in the middle here. A lot of stocks are doing okay, but still a good, maybe almost majority are not doing good. And yeah, there you go. I just wanted to cover some stuff there real quick. Pull this to the side. And yeah, so that's what we're looking at. You can expect probably by 2 o'clock things to get sour. I didn't really expect all day would have this, light green, and I thought what was going to happen was I thought the markets were going to look like the Dow Jones and S&P, where they kind of popped up above it and then failed it. But the comp just cannot even stay above this resistance point here, and we're going back to test this 7100 range. And that's that. If you're a bull, you better hope to God that the markets do gain support here. I went back and watched the video of yesterday. I posted it like 19 hours ago or something, maybe more. And I was like, oh, the market, it can just keep going and going and going. Well, it really could, but I don't. It's like they'd have to pump so much, like what they're doing with the bond market. They have to pump the crap out of the bond market, um, to prevent the yield from spiking up. That's literally what they have to do. And people say that the Federal Reserve, um, does backdoor buying and backdoor buys all the bonds. We can't see what the Fed does or what the Fed's doing. Um, that's why Rand Paul want to audit the Fed. They want to audit the Fed to see what the Fed's doing because they're absolutely manipulating the markets and we have no control over them. In 1913, that's when the Federal Reserve was created. They sneaked the bill through on Christmas, it's to if you look at the events in history, it's undeniable that this is just toxic for like real growth. This is toxic for um, you know what the founding fathers stood for. Um, we want free markets, not this manipulated crap. Um, And yeah, that was my little rant for today. All right, well, thank you very much for watching. This has been another breaking news covering some topics earlier today and covering the markets. Well, thank you very much, guys, and peace out.